We got this blunt tool, which is one of many tools we use to try to make this market work and to find those companies that are not doing the right thing.
I'd like to move us on now to the international agenda, the global agenda, global standard setting, which is actually just going to be talking about the same things you've been talking about, but in a rather specific context. After a long period of very little substantive hard standard setting at the global level, we now appear to be about to get some standards in the next few years. What's happening? How sensible is it? Is it going in the right direction? Why is it going in the right direction? Why is it not? Terri, do you want to kick off on this one?
You like this so much.
Okay. I want to read something, just like 2 sentences. And this is an article, as I said, the banking literature is just filled with this stuff. This is an article from 2007, Theories of Bank Behavior Under Capital Regulation, where the author looked at all of the papers that had been written up to that point in time about how the Basel Capital Standard affected the behavior of banks and the risk-taking behavior of banks. In light, and this is what the author writes, in light of nearly 5 decades of regulatory effort based at least in part on minimum capital requirements, one might anticipate that a perusal of the academic banking literature would yield considerable agreement that capital requirements are a worthy tool within a bank regulator's arsenal. In fact, the theoretical banking literature is sharply divided about the effects of capital requirements on bank behavior and hence on the risks faced by individual institutions and the banking system as a whole. In a nutshell, the research is contradictory. And there are several papers that suggest that that capital requirements, the Basel capital requirements, in fact led to more risk-taking by the banks. And there is a strain of theory post-financial crisis that the Basel capital requirements led to concentrated forms of risk-taking, more homogeneous forms of risk-taking in the banking sector that contributed to the global financial crisis. So the point is that, my point is that we have divisions about what the effects of these global rules are. We are embarking at the IIS on a project of creating a set of global rules. And if I have my biggest disappointment in the years that I was at the IIS is that we weren't able to convince people to really think this through before they started down this path. I think, I have heard, why do we need this? Well, we need this to deal with regulatory arbitrage. We need this because the Financial Stability Board's requiring it. We need it because it will enhance the reputation of the IIS to have a global capital standard. We need it because we need a level playing field. There are all these reasons. I think it would have been wonderful if the IIS had started this project by producing a paper that said, here are the problems, here's what we're trying to solve, and here's what an international capital standard will do for us. It is entirely, I am not disputing the fact that this may be a good thing, but the analysis has not been done. And it is equally possible, based on what I have looked at, that it could be a bad thing, depending on how it's created.
I think, Terri, that it is maybe a little bit unfair to the IIS. What is the problem, basically? The problem is that we have this important economic sector, insurance. It has 2 very important characteristics. It does not yet have an internationally agreed accounting standard. It does not have yet an internationally agreed solvency standard. Now, that is something, Terri, and I know you don't like it when I say that, but if you go to the ministers of finance and you tell them, insurance is so complicated, we cannot do that, you don't hold a credible language. And I think that the fact that the IIS now has to develop very quickly a solution is due to the fact that the attempts that you and I were part of before that have not succeeded. And so there will be an international capital standard because insurance is part of the global financial regulatory community. The question then is, what kind of standard will we develop there? And therefore, it is very important that we agree internationally on what I would look at a kind of a step-by-step basis. We have a financial stability board that has identified globally systemically important insurers. And they say, well, if you're globally systemically important, you must hold the necessary amount of capital. But we can't compare ourselves internationally. The US capital levels, the European capital levels, Latin American capital levels, African capital levels are not comparable. We need to have something that we can start from. And that is what is going to happen this year with a basic capital standards regime that will have to be developed for these globally systemically important insurers. And we'll have an international capital standards for internationally active insurance group. The question then is, what will this be based on? And Terri is right. You know, maybe you should write that paper so that you can give guidance to the international world. Why don't you do that? But the fact is that they're struggling to find something. That we need something, I think it's hard to disagree today, that we really need it urgently. And so I believe in a step-by-step approach where we establish comparability schemes and then try to move up maybe at a later stage to more kind of harmonized thinking about that.
So if there is value to this international capital standard, I think the value is in the ability to promote robust conversations within the supervisory college. So I think, I'm actually, I think, you know, if you have a benchmark and you say, okay, let's talk about how this firm looks relative to this benchmark and why it looks high or low, why it looks different. But I would call that then not so much a capital requirement as another analysis tool. It's like, listen, you know, do your review against this benchmark, and then let us use that to understand you better, your risks and how you manage capital. And I think if the IIS goes down that road, and I think that's really in the short run, there was a question about, you know, long run, short run. I think in the short run, that's where this can add value. This can be, you have something relatively blunt, you use that, groups do it, and then the supervisory college uses that as a jumping off point to better understand each other and each other's markets and each other's issues. Now, you made the comment, I think, about, you know, insurance supervisors, they tell the FSB and the G20 that, look, we just can't get to agreement because this is a global world. It's not just the insurance supervisors who are saying this, it's the accountants as well. You know, the Financial Accounting Standards Board in the US has said, we're going a different way on insurance contracts accounting.
Why?
Because there is a fundamental disagreement between, I think there's a fundamental disagreement on the issue of market consistent valuation.
Can't be that difficult.
It is, and so
Not easy, but it's not difficult.
there is post-crisis. All right, pre-crisis. Pre-crisis, I used to give speeches. I used to say, of course we need market consistent valuation. It's market consistent valuation that's the only real price out there in the market. That's what things trade at. Everything else is a made-up number, right? I mean, that's what economists, financial economists, accountants, that was everybody saying pre-crisis. Post-crisis, I have a completely different view. And post-crisis, I have found myself thinking, now wait a minute. Part of what makes especially this life industry work is that it is able to ride through volatility. It doesn't have a short-term mindset. Does market consistent valuation promote a short-term mindset that is unhealthy in the life industry? And there are more and more, you see articles where people say fair value accounting is part of the problem. It drives a short-term mindset, and it exacerbates, it makes the transmission of systemic shocks stronger, more forceful, more rapid. And we need to rethink this. So that rethinking is going on, and that's why we have this disagreement. So to think that, you know, look, we can't get agreement on accounting, but we're going to move full forward on a global capital standard with one view of accounting when there are potentially serious, very serious unintended consequences for the insurance industry that are not, that we haven't agreed on in the realm of the accounting system. I think it's dangerous.
Yeah. Let me just re-emphasize what is happening on the international stage so people can continue to follow your discussion. We have had designation of 9 insurers, and there are possibly more that are going to come, as globally systemically important, and that carries with it a number of implications. None of those are Polish insurers, but some of those global insurers certainly do have a Polish presence. Secondly, there is now an initiative to create a backstop or basic, as they're now called, basic capital requirement, a simpler, more factor-based capital requirement that will, so the designers hope, aid comparability across jurisdictions. That is, of course, a very much disputed point, and that is the design of that is meant to be produced by the end of this year. And that will be applied to the globally systemically important insurers, but with the potential of it being applied much more widely. And then thirdly, we have the initiative to create a more comprehensive alignment of regulation under COMFRAME. COMFRAME has many parts to it, but there is also the part that addresses a more comprehensive